Afternoon, everyone. I'm Charles Cordova, an economist with the New Mexico Workers' Compensation Administration. Since this presentation touches on finance, I need to make a quick disclosure. The views expressed here are my own and don't represent the New Mexico Workers' Compensation Administration or the state of New Mexico. Nothing here is financial, legal, or investment advice. Companies are named for illustration only, and all figures come from public sources. With that said, I'm going to try to answer a question today that many people are asking. Are we in an AI capital expenditures bubble? First, what even is an AI capital expenditures bubble? In simple terms, people basically think the giant tech companies are spending too much money on AI and it could cause a stock market crash. If this is a bubble and it triggers a recession, it has real implications for comp. I'm speaking about this today because I have a degree in finance, I'm an economist, and I've done a lot of AI work in comp. Based on my credentials, I'll walk you through three lenses on the situation. One is an economist looking at bubbles at scale. One is a financial analyst looking at the actual mechanics of AI spending. And one is a workers' comp professional on what it means for comp. Next slide, please. First, we're going to talk about the economics of bubbles. Typically, economists view bubbles through something known as the Minsky-Kindleberger framework. Essentially, this framework refers to the way human psychology drives stock market bubbles. It's a cycle where excitement over a change in markets causes investors to use debt to overfund investment, which then crashes financial markets once investors realize that the overinvestment has occurred. It's broken into five stages: displacement, boom, euphoria, profit taking, and panic. Today, we're going to talk about the first four, but we'll skip the panic stage since obviously aren't there yet. And if it does come, you definitely won't need me to tell you about it. Next slide, please. A displacement is when a shift in the economy leads to high investor interest. In the case of AI, this shift can be traced back to the launch of ChatGPT in 2022. What I'm currently showing on this slide is something known as the Buffett indicator, who called it probably the best single measure of where valuations stand at any given moment. You can calculate it by dividing total US stock market value by US gross domestic product. It's currently near the all-time high, which means there's more money in the stock market relative to the size of the economy than ever before. Next slide, please. This brings us to the boom, where money pours in and prices and spending accelerate. Here we're looking at the movement of the SOX semiconductor ETF over the last year, which I'm using as a standard for total AI growth. AI has seen absolutely massive investments, with AI-related companies generating around three-quarters of the S&P 500's gains since ChatGPT launched, according to JP Morgan. I'd note that that three-quarters includes everything, not just model revenue, but the cost of the build-out as well. If this was the gold rush, the rush itself is real. The people selling shovels are getting rich, but we're still waiting to see the gold. Whether or not we're in a bubble, we have definitely had both displacement and a boom. Next slide, please. The third stage of a financial bubble is euphoria. In this stage, investor caution disappears. Prices skyrocket and investors use novel, untested analytical methodologies to justify valuations that are detached from fundamentals. As an example, I want to talk about SpaceX. This company is a merger of a satellite business with decent fundamentals but a limited growth ceiling, and xAI, a small AI company with about a 3% share of the LLM market. Since the satellite side can't justify the price on its own, investors must be banking on AI growth to do it. What you see on the screen is the highest SpaceX valuation given by analysts compared to the total value of the world's largest stock markets. The valuation was given by Raymond James analyst Brian Giswali at an $800 a share price target, which would translate to about 10.5 trillion in valuation if realized. That valuation would make SpaceX more valuable than the entire Japanese stock market, which is the world's third most valuable market. It would see SpaceX valued at roughly 60% of every listed company in mainland China put together. Next slide, please. Up on the screen, you can see a quote by Brian Giswali that was sent in a client note. Just as railroads, electric grids, and the internet reshaped prior economic eras, we believe SpaceX is building the foundational platform for the next generation of industrial capacity. In order of the quote itself, I want to point out that the railroad bubble burst in the 1870s, the utility stock bubble burst in 1929, and the dot-com bubble burst in 2000. This analyst literally cited prior stock market crashes as a justification for his price target. The valuation invents a new methodology and then argues for why SpaceX should be valued differently than other companies. That's a classic warning sign of bubble euphoria. Next slide, please. Profit taking is when smart money quietly heads for the exits while everyone else is still buying in. After a historic run, the AI trade is showing signs of cracking. Up on the screen, I have four tickers indexed to early June. Red is chips, the shovel sellers. Gray is the Magnificent Seven, who are funding the AI build out. Blue is the NASDAQ, the broader tech sector. And green is the Dow, which has low AI exposure. What's interesting is that all three AI exposed indicators have pulled back in the last couple of months. Importantly, the Magnificent Seven in gray, the people funding the build out of AI infrastructure, have been underperforming the technology sector as a whole, shown in blue. On the other hand, the shovel sellers in red were overperforming it until a couple of weeks ago. Meanwhile, the low exposure Dow has been the one climbing over that period. Broad optimism giving way to selective pullback is what profit taking looks like. Please note that profit taking is only ever confirmed in retrospect. Not all booms bust, and you can have a boom that is legitimately supported by growth. I'm not here calling a crash, I'm just showing you signs that are consistent with the pattern described in a Minsky bubble. And as a reminder, we're skipping the final panic stage in this presentation, but possibly not skipping it out in the real world. Next slide, please. I've spent the last four slides telling you that this looks like a bubble, so I want to make a case for why it's not necessarily one. Because I'm an economist, and as the saying goes, economists have predicted 9 out of the last 5 recessions. First, this isn't 1999, and there are very real revenues that are growing rapidly. According to a recent report by Exponential View, deduplicated 12-month trailing AI revenues were estimated at 110 billion, which represents a little over 3 years of revenue growth. The chart up on the screen is from that report, and it shows AI revenue growth accelerating. There are two lines. The gray one is trailing 12-month actual revenue, which is money already earned. The purple line is just the most recent month and multiplies it by 12 to show what the pace would look like if it held steady for a year. Both are climbing fast. The companies spending the money have what's called fortress balance sheets, which is finance jargon for enormous piles of cash that can absorb losses for years. That's different from the dot-com era when cash-burning startups ran on borrowed money and folded the moment funding dried up. Today's spenders can hold out longer, waiting for revenue to catch up, and if it does, then there's no bubble. Recently, Google Cloud revenue grew 82% to 24.8 billion. Even more recently, both Microsoft and Amazon reported strong cloud service revenue growth as well. At least some of the expected revenue is real, and the growth is accelerating. If it keeps up, it could justify the spending. But Google also reported negative free cash flow for the first time ever. Amazon's free cash flow just turned negative, and all of the hyperscalers' free cash flow is already negative or dropping fast. So why is that important? Next slide, please. So what has to be true for this to pay off for these companies? If the growth we just looked at holds, the math could work out maybe, but demand estimates and revenue forecasts vary wildly. I'm going to walk through some numbers here, but I want to flag up front that I don't fully trust any of them, and I'll explain why in a bit. That said, before AI revenue can even have a chance of justifying AI spending, we need to build out infrastructure to meet projected demand, which requires extreme capital expenditures, which in turn requires extreme revenue growth to pay for everything. Capital has to earn a return, so today's CapEx sets tomorrow's revenue bar. A 2025 Bain report estimated we'd need about 500 billion a year in CapEx by 2030 to meet AI demand, and it would require 2 trillion in annual revenue to justify it. Goldman Sachs now forecasts 765 billion in CapEx for 2026 alone, which is already above the 2030 number 4 years early and pushes the revenue bar closer to 3 trillion. And I'm deliberately using Goldman's smallest number. Their own chart shows CapEx rising past 1.6 trillion by 2031. There are also risks beyond the financial uncertainty. Meeting any of these demand estimates requires a huge data center buildout, and that buildout is facing real political pushback. Some jurisdictions, including New York, have placed moratoriums on new data centers. And the power grid itself can't handle the projected load, which means it isn't just a data center problem, it's also a grid investment problem. There are also signs that the capital requirements are outrunning the usual ways of funding them. In June, Google raised nearly 85 billion in equity, which was the largest equity raise in corporate history and their first since 2006, signaling these firms are essentially tapping every capital source they have to fund this build out. Equity is the most expensive capital source, and firms typically reach for it last. Further, recent reporting suggests there's an enormous amount of debt tied to this build out that doesn't show up where you'd expect. Nikkei Asia put it around $1.65 trillion. And this is the part that matters for comp. It's largely not sitting on the hyperscalers' balance sheets. The data centers are built and financed inside separate entities called special purpose vehicles that are funded by private credit, banks, and institutional investors, while the hyperscalers just sign long-term contracts to buy the compute. If the demand doesn't materialize, the company that overbuilt isn't necessarily the one holding the bag. Whoever funded the vehicle is. And I'm honestly not confident in that $1.6 trillion figure. That's the point. This debt is hard to see. We've put massive capital into AI and now need a massive payout to justify it without good data showing that the payout is coming. And the debt is spreading. That's the same basic mechanism we saw in 2008. Risk starts concentrated in one place, gets spread out into other sectors that look completely unrelated until they aren't. And that includes private credit, which is an area insurance companies have been leaning into to increase yields. Next slide, please. For this to all pay off, projected revenues have to actually materialize. And this is speculation, but I personally think compute would likely need to get cheaper too, so the two can meet in the middle. But my point is that an AI crash isn't guaranteed, but a lot has to go right for revenue to justify current CapEx levels. Basically, everyone has a forecast right now, and I want to be clear, none of these numbers are reliable, including the ones I've shown you. Forecasting works by using past data to infer future behavior, and the more data you have, the more it holds. AI just hasn't been around long enough for anyone to responsibly extrapolate its trajectory. What I see is very educated people running complex analyses, but what I hear is extrapolation bias. Up on the screen, I've shown a chart of what that looks like. I made my own revenue forecast by eyeballing the exponential view run rate from earlier and running a regression analysis out to 2031. It came back with a near perfect fit and a projected over 2 trillion in revenue by 2031, enough to almost meet Bain's target and roughly justify the capital expenditure levels from when that report came out. Next slide, please. Here, I've extended that same OLS regression to 2050. The same regression analysis now predicts that AI will roughly take over the entire global economy by 2050. At that point, we're not doing economic modeling anymore. We're choosing which pill to take from a guy wearing a leather coat and sunglasses indoors. We know this forecast matches what already happened nearly perfectly, so it's reasonable in the near term, and we know it's absurd over a long enough timeline. At what point does it go from accurate to absurd, and how can you predict that? That's also setting aside a deeper problem with the revenue itself. The $175 billion figure wasn't actual revenue, it was 1 month's revenue times 12. That annualized figure overstates the reality the whole way through at every point on the chart. And even that overstated line only barely gets you to Bain's older, lower CapEx target, nowhere close to where actual spending is today. On top of that, current demand is priced on subsidized tokens, so we don't have data on unsubsidized demand. Further, CapEx has accelerated substantially since the Bain report, so the true revenue bar is even higher than the Bain report implies. And that's just not one, or it's not just one shaky number that makes that up. Forecasts don't rest on a single assumption, they depend on many data points. When multiple numbers are off, the errors compound and lead to wild swings in either direction. That's a garbage in, garbage out situation. The scale here isn't small either. We're talking about trillions in capital expenditures running years ahead of any proof that the demand exists. Even if some of the revenue is real, that's the same investment behavior we saw in the dot-com era, except on a larger scale. Technically, the demand could be real, but nobody actually knows how things are going to play out, no matter how confident they sound. Even in the best case, the demand numbers are hard to hit, and there are a lot of ways that this could go other than the possible best case. So what happens if the analysts are wrong the way they were with the internet, the railroads, the subprime lending crisis, or any of a dozen other bubbles? And what does that mean for comp? Next slide, please. Not every crash causes a recession, but they often go hand in hand. Depending on how the AI bet plays out, I want to look at three pathways: a bear case, a bull case, and a middle path. Please note that everything in this section is speculative, and it's based on how comp responded to prior recessions, which may not resemble an AI-driven one. First, in the bear case, this is a bubble, it bursts, and it causes a recession. NCCI released a report in 2019 that discusses how recessions impact comp. Notably, reductions in employment and payroll can impact premiums. Since premiums are a function of payroll, reductions in both or either will put downward pressure on net written premium. Historically, injury frequency also falls during recessions, driven by reduced payroll, shifts in the industry mix, and rising average employee tenure, since newer employees are the first cut in a layoff and the last hired back. That effect then reverses as employment recovers. Building on the NCCI report, a recession could possibly hit comp finances from two directions at once. The first is premium, which is rate times payroll. Premium shrinks the moment employment does, while the cost relief from lower injury frequency lags behind, squeezing insurer balance sheets in the short run. The second is investment income, and it depends on the rate path. If rates fall, reinvestment yields drop, but the existing bond book gains value, so that path is manageable. The one to watch is rates rising at the same time as markets crash, which is plausible with inflation at 3.5% and the FOMC generally turning towards a more hawkish position. Then the bond book takes losses alongside the rest of the portfolio, and premium is falling at the same time. On the other side of the equation are reduced claims costs, not just frequency and severity, but potential indemnity reductions too. Consumer spending has been strong thanks to what economists call the K-shaped economy, where the top 10% of households drive an outsized share of spending and earnings growth, while the rest stays flat. Because the top 10% hold the most equity, if markets crash, spending pulls back and wage growth slows. Since indemnity is mechanically tied to wage levels, that puts downward pressure on long-term indemnity costs. In the short term, in other words, there's significant industry risk from reduced premiums combined with systemic risk many insurance companies have due to horizontal integration. Additionally, insurer investment portfolios have exposure to market forces. To manage that risk, comp insurers should consider fortifying their balance sheets now, and not just from comp-specific pressure, but also horizontal integration pressure across lines. I'd also like to flag exposure tied to data center build-out specifically. This is outside of my core area of expertise, but my understanding is that data center debt exposure can surface in more than one place, including parts of a portfolio that looks safe on the surface, such as private credit holdings or even investment-grade bonds. Next slide, please. The bull case matters for comp too. You'd think AI meeting investor hopes would be good news across the board, but I want to make a case that it may be more mixed for comp specifically. Past transformative technologies have traditionally moved people from physically intensive jobs to less physically intensive jobs. This in turn has tended to put downward pressure on injury frequency over time, contributing to a long-term reduction in premiums and overall systemic costs. AI could break that pattern. So far, early job losses have hit white-collar workers the hardest, notably computer programmers, while healthcare, thanks to an aging population, has stayed resilient to AI-driven cuts. Healthcare also happens to be a relatively high injury industry. And with housing shortages pushing more workers towards construction and similar trades, we could see the labor force shift towards more dangerous work overall, which is the opposite of what past transformative technologies have done. That combination, a shorter tenure and a shift towards higher severity work, would likely push both injury frequency and severity up. If the industry mix shifts towards more dangerous work, premiums would need to rise with it. But comp has been the most profitable property and casualty line for over a decade, built on the assumption that injury frequency keeps declining and rates are priced for that world. If AI reverses the trend, costs climb into rates that were never built to absorb it. So paradoxically, the bull case that would be genuinely good for the US economy could be bad for comp specifically. Next slide, please. There's also a third possibility here, and it's probably the one I personally think is most likely, although don't quote me on that. That would be that AI is genuinely transformative, just not at the pace that the market currently expects. Transformative technologies are usually introduced with a bubble, but not always. Sometimes you get all the warning signs without enough capital at risk to cause a real crash. In this case, AI would keep growing and disrupting, but opportunity cost adjusted revenues would never fully justify the spending. Markets deliver repeated pullbacks and years of flat to mediocre returns instead of one dramatic crash. The downsides for comp include float reinvestment income underperforming actuarial assumptions year after year. Equity-heavy portfolios grind sideways, and rate adequacy erodes slowly instead of breaking loudly. You'd likely also see a slower version of the employment shift from the bull case, a gradual move towards more dangerous work and away from safe white-collar jobs, with long-term disruption elevating injury rates over time rather than the short-term effect, tenure effect being temporary. On the other hand, AI-driven efficiencies in healthcare could also push costs down. Again, this is all speculative and it's hard to make any firm long-term predictions here. But I'd encourage the industry to think about what this scenario means because a crash gets a task force. A decade of 4% returns gets a footnote, but it's a footnote that quietly reprices the entire comp system. Next slide, please. Thank you. I hope this was helpful information for you today. I put my contact information up on this slide in case anybody'd like to reach out to me after the presentation. There's a lot more to this whole thing than we had time to cover today, but I tried to cover some of the most important points. If we had time, I'd like to see if anybody has any questions for me.